We call them the usual suspects who, whenever the market goes through a rough patch, which are inevitable, will get phone calls. Maybe not quite at panic level, but I have had a few panicked phone calls over my career. And when it comes down to that point where you've done the education, you've taught them how we're going to react to it, and they still don't follow the instruction.
This is Brandon Turner, and you are listening to the Average Joe Finances Podcast.
If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavaggioni, and today's guests are Alex Cabot and Ed Lambert. So Alex and Ed, thank you so much for joining me today.
Thanks for being here, Mike. We're looking forward to this.
Yeah, we're excited, and we've learned a little bit about your show, and can't wait to get started.
Awesome. Fantastic. Hey, I want to start this off the same way I start every podcast episode off, and we want to know more about the two of you. So if you could share with us a little bit about your background and your story, you can go as far into it as you want or as little as you want. That's fine.
Why don't we start with you, Ed? Your origin story is more traditional than mine.
Sure. That's what we'll do, Mike. Yes. Our business is based out of the Philadelphia area. We have a small retirement planning team, and I grew up in the area. I knew by the time I was 19 that I wanted to be a financial advisor for a living. So essentially, I went to college. I got into economics. It was the late 90s. Tech boom was rolling in the stock market. It was exciting. I was working a summer job. I was buying some stocks with some money that I saved. I saw that money growing. My father owned a construction company. And what I realized was that he didn't know a whole lot about finances. He knew how to run a business, but he didn't know a lot about finances. So I started thinking, maybe this is something I could do for a living. I really enjoy doing it with my own money. I enjoy learning about it. I enjoy talking about it. And I see there's a lot of people like my father who are successful in business or whatever they do, but they just don't have the background or the understanding to know how to do financial planning or how to invest their money. So I knew relatively early I wanted to get into this. So I got an internship at Dean Witter, actually worked there, got hired directly out of college, which was Dean Witter was merged with Morgan Stanley. So it was Morgan Stanley by that point. And this was in 2001. And 7 years later, I actually met Alex. So we started working together at Morgan Stanley then in 2008. We were on a team that broke off from Morgan Stanley in 2009. And then 3 years later in 2012, almost 10 years ago now, Alex and I left that company to start Birch Financial. A lot of our clients came with us. And we built this team that we have today with 7 employees. We work with about 400 families, manage close to 450 million in client assets at this point. And markets go up, markets go down. We have a lot of fun doing what we're doing. And in our view, we do a lot to help people.
Some days are more fun than others, I'll admit. But my origin story, so to speak, is very different. Ed knew from a young age that he wanted to do this. I mean, he said, 19, you knew. For me, it was very different. If you ever heard the expression, a jack of all trades, a master of none, that's kind of me. I have a lot of really varied interests. When I was in college, I studied classical literature and physics. Prior to going to college, I thought I was going to go into medicine. Both my parents are physicians, and that was just an assumption that I would go down that path. I realized when I was in college, I had absolutely no interest in pursuing a career in medicine because I don't like sick people. And that just didn't seem like a good fit. Eventually, I was going to pursue a career in academia. And I had a couple offers for fellowships for a PhD. And I had a moment where I said, oh gosh, I'm about to spend the next 6 years of my life studying something that like 150 people in the world care about so that I can spend the remainder of my life researching and teaching something that 150 people in the world care about. And that didn't feel right. I toyed around with the idea of law school. I almost joined the Navy to become a fighter pilot. Top Gun was one of my favorite movies as a kid, and it just felt right. But the timing didn't quite work out on that. I am a pilot, and that's cool. So I don't fly A-18s, but smaller planes. And eventually I meandered into this industry almost by accident. I realized that I'm pretty good with numbers. I'm pretty good with people. And this just seemed like a good fit. So I started with a brokerage division of a bank in this area, moved over to another regional firm. And then I joined Morgan Stanley in 2008, which is where I met Ed. And he filled you in on the details from there. And I think Ed might still be a little salty because when I joined the team that Ed was on back in 2008, you remember 2008 was the year of the financial crisis and the world fell apart. And there was a lot of questions about whether some of these massive companies would even survive. The world wasn't completely falling apart by the time I joined the team. As soon as I joined, every bottom just fell out. So I think Ed still holds a little bit of a grudge, thinks it's my responsibility, that I had something to do with it. I've told him innumerable times, it wasn't my fault, I promise. But one of these days, he's going to forgive me.
As they say, Alex, correlation always proves causation, right? Always.
I think you might have that one backwards, Eddie.
So that's great backgrounds on both of you and how you guys met and got together to start the company that you have right now. I just want to say, Alex, at least you were going to join the right branch. I just retired after 20 years in the Navy. It's
right on.
Yeah, that would have been the right call. So
I agree, 100%.
Top Gun, I think, did that for a lot of young boys back in the day. It was all about, I want to be a fighter pilot. Me and my friends we grew up on Long Island, New York. We used to ride our mountain bikes around the neighborhood and stuff, pretending we were fighter jets and stuff, and like trying to knock each other over. And it was fun. So it's funny though, because I'm looking over, like I was taking some notes as you guys were talking, and there's some key differences like that I'm picking out from the two of you, like how Ed knew like right away that this is the career field he wanted to get into, right? And Alex, you had a like upbringing when it comes to how you got into the industry, right? Doing a couple other different things before you got into it. So do you guys think that the mixture of the two of you is what makes you guys mesh so well? Is the fact that Ed was like, I'm all in like right away from the get-go, and then you did other things before you came in here, so you brought like that outside experience, I guess maybe like a different thought process to the table?
I think it's a great way to describe it. And what I've explained it to people like this is that Ed and I, at our cores, are very similar. We have the very similar value sets, very similar just goals and ambitions in life. We're both very honest and open, and we try to treat everybody with respect and do the right thing as often and as best we can. But on our surfaces, we're very different. We look different. We sound different. We have very different backgrounds, and those differences help us to provide a more comprehensive look at things. I may see something very differently than Ed does simply because I have a different background, and likewise with Ed and with me. So I think that there's something to be said for that, having those different backgrounds. But and we also, if you ever look up like the Myers-Briggs personality tests, Ed and I, they're not identical. The first and the last letter of the Myers-Briggs are different, but our middle two are the same. And that's usually a sign that we're going to be pretty compatible as business partners. And it's worked out so far. 14 years and counting, and we're still in good shape.
Yeah, I think one real key, Mike, for our success over the years, like continued long-term success, is that neither of us has an ego big enough where we have to control everything. We're very willing to share the ideas, the credit, everything. And so for a partnership to last a long time, a business partnership, you really have to have that mindset. A lot of people, as time goes on, their head grows too big, and all of a sudden they want to be the big decision maker, or they think they're infallible. So I think a lot of it has to do with having that teamwork mentality and everybody having reasonable egos, for lack of a better term.
Yeah, no, that's great. You guys definitely complement each other. And Alex, you're over here saying you guys don't look like, I thought you guys were twins. I was just going to ask, are you guys like actually separated at birth?
I have referred to Ed as my brother from another mother. So
go.
I don't think there is an actual genetic relationship unless you go really far back, and you'll probably find one. But yeah, we've definitely known each other for a long time, and we get along well, both in and outside of the office. And Ed talking about the ego thing, sometimes I will play up a little bit of tongue-in-cheek arrogance of certain things, not with clients or anything like that, but sometimes with service providers and like our video production company. They know me as like a jokester in that respect. But when it comes down to actual decision-making, I think both Ed and I are reasonably humble in how we make our decisions, and we trust one another. And I trust Ed with my life, and I hope he feels the same way about me. So we have a vested interest in doing the right thing, not just for ourselves, but for both of us, for our company, for our families, for our clients, for everybody. And it'll all benefit if we just keep doing it that way.
So I'm glad you bring up that word, Alex. You bring up the word trust, right? Because looking at how you guys did what you did in 2008 is when you guys met. Just a year later in 2009, separating with another team, right, to go off and break off from this big firm that you guys were at, that you probably had a pretty safe environment, like a safe job, right, to go off and do something else with a brand new team, right? And then a couple years after that to branch off and start your own business. So I feel like there has to be some form of trust there. So it definitely looks like you guys have a great working relationship together. Now, when it comes to your clients, so you guys have a great relationship together, I feel like that would reflect on how you treat your clients as well, because when you have such a good working relationship, the tone of the office itself will project itself out. I feel like your clients also get the benefit of that when it comes to working with you guys.
Yeah, the old expression, like attracts. And what we found is the people that come into our office that tend to want to work with us are the kind of people that we want to work with, who value the right things, or at least the things that we find to be important, like trust, like honesty, like treating people well. And a lot of times clients will ask, especially when we talk with them now, the markets are beaten up. Your phone must be ringing off the hook. People must be giving you a really hard time. And honestly, we're not experiencing that. We're very fortunate. And one thing that we hope is that people that aren't a good fit for us are repelled by us, because that would be the ideal situation, right? Nobody calls us and yells at us over the phone. They understand we're doing everything we can. They understand we do everything by the book, and that we care very deeply about them as well as their personal finances, but them as people, they're not just numbers on a spreadsheet to us. And our team feels the same way about our clients. And our team hopefully feels the same way about Alex and me as their employers as well. But to us, that's really everything. We're here because we want to help people. It's not making money is nice, supporting our family is nice, putting ourselves in a good financial position is nice. But first and foremost, we're here to help people with their money. And the most important word is help.
Yeah.
There is a downside to it, though, and
Sure.
that we build these relationships with our clients, and some of them primarily become friends, and then friends first and clients second. And that doesn't happen very often, I don't think, just from people I've spoken to. But I think one of the biggest problems, the biggest challenges, at least for me, is that you build these very deep, meaningful relationships where you really do care about someone, and then something bad happens to them. And then not something that I did, or not necessarily market related. I have a client who lives in Florida, and her house was very badly damaged by Hurricane Ian. Very bad. It's going to take probably a year to get it back up to a livable capacity. And from a financial standpoint, it's a challenge. But I'm far more impacted by the personal aspect of it, because I've known this woman for, probably 15 years now. And I've been to her house, and I know her husband and her daughter-in-law and all kinds of people. Her mother, she and her mother made my kids quilts when they were born.
Mine too.
Yeah. And it's somebody that I care about so much. And it makes us good at our jobs because we do care that much, and we want to do everything the right way so that they'll be okay. But when something out of our control happens to them that's unfortunate, it's painful. We feel that discomfort along with them. And maybe it's not necessarily a bad thing. It's just, it makes it a little bit harder. So I wouldn't trade it for a dispassionate, disinterested, fully professional relationship for all the money in the world. But it does present a few extra challenges, we'll say, as time goes on.
Sure. Yeah. So see how you get very personal with your clients. It's not just about building up that transactional relationship. It's about building an actual relationship with them as well. And I think that goes along with some of the topics I want to discuss with you guys today. So I want to talk about financial planning, investor psychology, and then of course the markets and the economy, right? But I feel the way that you guys are talking about this, like the way that you work with your clients, I think actually helps them with their investor psychology, right? Because I feel this is something I've talked about in my podcast several times, but it's about having that right mindset, right? So what do you guys do to help your clients create that right mindset to achieve financial freedom?
One thing we do right up front, Mike, is when times are going well, we talk about the inevitable tough times, that they're coming. We call it a fire drill. And we talk about what's going to happen. Sometimes the markets are going to decline. We don't know when the decline is going to start. We don't know when it's going to end. We don't know what's going to cause it. It's just natural. We explain to them the history of the markets, average declines during bear markets, and how long they may last, and the likelihood of turning a profit. We're losing money in any given year historically. Really prepare them for these things so that when these times come, we say, okay, we've prepared for this. We've diversified. We've talked about what we're going to do when the markets decline in value, which is in most instances, we're going to stick with our game plan, right? And that our game plans were created for both good and bad markets. And our financial plans were designed to take into account the certainty of tough times. And that one of the most important parts or most important aspects of long-term success is preparing yourself emotionally for the hard times when you're not under that pressure, right? So that you do the right things, you know, when you are under the gun, just like you guys always did in the military, right? You prepare when you're not under duress so that when you are under duress, you know, your training takes over and you do the right things.
Yeah, train how you fight. So that's what we call it. I like that. So these fire drills, it's like, what would you do if things go bad? What would you do in that situation? So if you have it already in your head, like if things are going bad, like you already know what you're going to do. When things actually go bad, it's going to trigger and it's just going to move like a well-oiled machine. I think that's like a very significant point.
For most people, that's how it works. But there are a few, we call them the usual suspects, who whenever the market goes through a rough patch, which are inevitable, will get phone calls. Maybe not quite at panic level, but I have had a few panicked phone calls over my career. And when it comes down to that point where you've done the education, you've taught them how we're going to react to it, and they still don't follow the instruction, they still can't get through it on their own. Our job is just to listen, to empathize, to explain things again in great detail, and to just be beside them, to be that hand on their shoulder saying, hey, I know this is uncomfortable. It's uncomfortable for me too. And one thing I've told a lot of people is that if you don't get anxious when the market is volatile, that's an indication of something wrong, because it's a physiological, biological response. We are programmed as humans to respond to external stimuli a certain way. The fight or flight response, if you've taken Psych 101, you learn about the fight or flight response, and we will react to things whether or not we want to. And with the fight or flight response is great if you're facing, say, a tiger, because your body gets ready for either running away or trying to fight. If it's a tiger, I would recommend running away if possible, or unless you're armed, in which case, but we're not going to get into that. But with market volatility, you can't fight it. There's nothing you can do actively to fight a down market. So the only option that your brain has left is flight. And when you flee something like that, empirically speaking, it's generally the worst thing you can do. So our job in that sense, when you do get someone who can't quite follow the fire drill rules, is just to be there for them, to explain it again, to make sure that they're okay, to check in with them. One of the big things is that we try to stay in constant communication, and we try to call our clients about every couple of months, even if it's just to check in to say, hi, has anything changed? How are you holding up this year? I know the market's been volatile. Are you feeling okay? Are you getting anxious? From a financial standpoint, we think you're fine. But from a psychological standpoint, you might not be. And that's very important to be proactive. As much as I hate that word, it's one of those buzzwords. But if you're just reacting to those frightened, anxious calls, you're not doing your job well, and in my opinion. So we try to be very active in our communication and make sure that we're getting out in front of any concerns if possible.
Yeah, you're reassuring them to stay the course, right? It happens. So in the Navy, right, sometimes you can come off course, right? You got to right the ship and get back on course. You're going to get to your destination, which in this case is financial freedom, right? I could use some of my circumnavigation of the open ocean right there. Yeah, no, that's fantastic, because I feel like especially in today's market right now, that there's a lot of fear out there. And actually, I'd like to talk about that a little bit. So what really happened in the first couple months here, actually really the first 6 months of 2022, we saw a lot of volatility, a lot of not so much crash and burn or doom and gloom, but it feels like it's looming, right? It feels like something's coming. So what do you guys think lies ahead right now?
That is a good question. And as much as I would love to use a crystal ball, mine's in the shop right now. So I'm going to have to use
Is it getting repaired?
It's been in there for a while. I'm not sure what's going on. There was some fouling in one of the pistons. It's very strange. But when we look at this year, I see this year as defined by mean reversion. And what I mean by that is we had 3 years, 2019, 2020, and 2021, where the market did extremely well. 3 straight years of very solid outperformance, pretty much across pretty much every asset class. And that in and of itself is pretty remarkable to have 3 straight years like that. To throw a pandemic in right in the middle in early 2020 and have that type of investment return is downright mind-boggling. So you look at the genesis of most of that return subsequent to COVID happening. And the only reason the market didn't completely crater in 2020 was the stimulus, was the Fed cutting interest rates, the Fed printing money, and Congress authorizing so much to be spent. That was a very important thing, I think, to do, because if the government had just let it do its thing and just shut people down, but not put any stimulus out there, I think we'd be in a much worse position right now. So with all that stimulus and the economy made it through, COVID started to slow down, the world started to return to normal, and people were left with a whole bunch of money that they were sitting on and a massive amount of pent-up demand to do stuff and to buy stuff. So my wife and I, we travel a lot with our kids, and I have not been on a flight that has not been full as far back as I can remember. And there's just this massive amount of demand. And when you get constricted supply and high demand, you get inflation, and that's a problem. So then the Federal Reserve has to act to deal with that. And that's where we are now. I think this is just getting us back to where we would have been if COVID hadn't really been an issue, if we didn't have the big drop. There's the very sharp but brief recession, and then the subsequent rise with all the stimulus. Because if you look back 5 years, 7 years, even 3 or 4 years, the market performance has been fine. The average annualized return over any relatively long trailing period of time doesn't raise any alarm bells. And if you look at point-to-point numbers, everything makes sense. But because everything went up so sharply at the end of 2021, this is just the pendulum swinging back the other way and getting valuations returning more to normal. And if Ed wants to add anything to it, I don't know if he probably has a lot more insight.
I feel pretty much the same way as Alex. That what the Fed did and what Congress did in 2020 was necessary. They chose the lesser of 2 evils. Neither choice was a good one, Mike. But if nothing had been done, when the unemployment rate went from 3.5% to 14.3% in 60 days, guess what? Spiral time, right? A lot of those businesses would have never reopened, and then banks would have been stressed, and so forth and so on, right? In the end, though, you can't artificially create a sustainable economic boom with printed money. But they needed to print the money, right? So all of that stimulus, $5 trillion roughly, was printed and handed out. Once it was spent, it stays in the economy. It just keeps circulating, right? And when the interest rates were held at 0, the velocity of the money is quite high, so it circulates very quickly. If there's any criticism, at least in my view, of what Congress and the Fed did, was that the faucet stayed on too long, that we probably would have been left with a fair amount of inflation. There was no way around it. And again, hindsight's 2020, right? These are some of the top economists in our country. But as we look back on it, our inflation now may be less high and maybe less sticky if the stimulus hadn't gone as long as it had, or the quantitative easing hadn't gone on as long, or the 0 interest rates hadn't actually continued until 7 months ago, believe it or not. But that being said, they had some tough choices and they chose the lesser of 2 evils. And the artificial aspect, that asset boom that was created by that, is now, like Alex said, it's normalizing. It's a reversion to a mean.
Yeah, no, that's all very good points, because the biggest thing that I think, the biggest takeaway from this, like you guys had mentioned, is that you can't just print all this money and expect there to be no consequences in the future.
I don't think they did. I don't think they expected there to be no consequences.
It was the lesser of 2 evils, like you had mentioned earlier. So it was like, something had to be done. Either we were going to crash and burn right then and there. Yep. The economy was going to fully tank right there. At least now it's a slower healing wound versus a huge gaping hole in your chest. Right.
That's right.
So now it's just like you got a slash there, and it's slowly healing. In that healing process, there's some infections and all that other stuff that got to get taken care of. It's just, sorry, I get very analytical with all these things. Or not analytical, but I like to talk in, what's the right word here?
Analogies.
Analogies.
Yeah.
Yeah. So there you go.
That's a great way to explain
I
it.
heard a good one from a cardiologist who said that the patient was having a heart attack, and the doctor had a choice of administering too much heparin, which is a blood thinner, which helps to let the heart keep pumping, or not administering any heparin at all. And you take too much heparin, and the side effect can be, you can have, if you get a cut somewhere and you've taken heparin, it's just going to keep bleeding. It will not clot. So you could have internal bleeding, you could have bleeding from your nose or your eyes. But if you didn't take the overdose of heparin, you would have died. So that was an interesting analogy, a little gory for my taste, but again, that's why I didn't go into medicine. So here we are.
Yeah, but again, it's a very great point. And I think it's good for people to understand what's happening right now, why it's happening, because you could sit here and be like, oh, I feel like they're not doing enough. They've done plenty enough, because it could have happened a long time ago, and it could have been a lot worse.
Yeah.
That's right.
So now it needs to run its course. We need to let this correction happen, right?
Yes.
And again, it's going to be market specific. Everybody's feeling it, right? The stock market's getting hit, the real estate market's getting hit, but it's got to run its course, right? And we got to let it happen. But there are ways to safely keep on investing while this is happening. Now, I know a lot of people talk about make sure you pay off all your debt, and like I talk about that too. I talk about paying off your consumer debt, right? I believe all debt's bad. I happen to like debt a lot, and I leverage the crap out of it. Like what I'm doing right now with the equity of my house. I leverage that with a HELOC, and I've used it to buy more real estate, right? So stuff like that, I think, is fantastic. But then there's a lot of people out there that are just like, no debt whatsoever. Like especially with the way the economy's going, you don't want to have any debt, even the good debt. What do you say to people like that?
I think a lot of it comes down to, and I'm sure Alex feels the same way, we've talked a lot about this over the years, it comes down to personal preferences and comfort levels with debt, right? If you're able to handle market volatility well and stick with your game plan, Mike, even though you've leveraged out your home to buy more real estate and so forth and so on, and you're comfortable with that, then you're doing the right thing for you, right? If doing something like that would keep you up at night and cause you to make rash, emotional type decisions, then that wouldn't be the right thing for you. So a lot of times what we do is we talk with individual clients about their own situation, what they're thinking about, their comfort levels, and we explain the pros and the cons, carrying more debt and leveraging assets more versus not leveraging assets more. But one thing for sure is investing, at least with the way that we do in the capital markets, stocks, bonds, commercial real estate, some precious metals. With prices down, it's historically a very good opportunity for people to buy things cheap. As Warren Buffett always said, the stock market's the only thing that everybody runs away from when it goes on sale. And think about it this way. Let's say the U.S. market's down close to 25% since the beginning of this year. That means that $1 that you invest today, when the market recovers to where it was in January, let's say it takes 2 years, I'm just picking a number out of thin air, right? That's a 33% return on that dollar, because the recovery rate when you're down 25% is 33%. That's if it takes 2 years. That's a great return on that money in a 2-year period. In a 3-year period, that's a very good return on your money. One thing we know about market declines, that they end. And they don't end when you expect them to. They usually end before the economy recovers, as we saw in 2009. We saw that honestly in 2020 as well.
Short-lived, but yeah.
Yeah, think about the market recovery in 2020, right? S&P loses 34% between February 29th and March 23rd and regains all of it by the beginning of August.
Yeah, that was wild.
And COVID was still spreading. Mind-boggling, right? And Alex and I are predicting a fast end to this or a quick market turnaround in the next month or two. We don't know. But that being said, when you're able to look at the market, look at the history of the markets, look at a chart of the market over any long period of time, the one thing you'll notice when you look at a chart about every decline is you'll look at that decline and you'll think of it as, man, that was a great buying opportunity. And our view is eventually this will turn out the same way.
And as far as debt goes, if I could share a personal story, I'm 42 years old. I paid off my house when I was 39. So I have no mortgage, no debt to speak of. From a financial perspective, that was a stupid thing for me to do because I make pretty good money. I could easily afford the mortgage payment, no problem. The interest rate was extremely low. The expected rate of return on my long-term investments is far higher than that. So why in heaven's name would I pay my mortgage off when I was borrowing at 4% for 30 years? And the answer is very simple. My career, my job, it is heavily based on the capital markets. So my income fluctuates, and it fluctuates due to completely out of my control. And when we went through market volatility, there was no real reason for me to be nervous, but I would always get more anxious than I probably should have. And I realized that if I had all my debts paid off and I had enough money to generate enough income to pay my taxes and buy food and make sure that we could have absolutely the bare necessities and hypothetically just not have to work or not have to make any money, knowing that I could get to that point. And so I paid off my mortgage about a year, maybe half a year before COVID started. So we go through this massive period of volatility. The market got cut by a third in a month. I was obviously very uncomfortable about that, but I knew I was sitting in my house, working from home, my family's with me, and I'm just looking around saying, okay, I own this. Nothing can change that. I can't lose my house. My income might be in the toilet this year, but I'm going to be okay. That helped me to avoid making stupid choices. And if doing something that may not be empirically correct helps you avoid doing things that are psychologically incorrect, then it's worth it, as long as you can stick with that plan. But you have to do everything thoughtfully. You have to understand what you're doing, how and why you're doing it. That's very important.
Now, the why is important. The why is important. So I feel like you have a very good why. Your reasoning behind why you did what you did makes perfect sense, right?
Now, to flip this back to you, Mike, for example, being retired military, right? You did your 20 years, you get a pension now, correct?
Yes.
So if I was retired Navy and I had a pension coming in, I'd be viewing that as something very stable that I would know I could rely on. And knowing that's always going to come in, I'd be much more likely to leverage myself out further than if I was already leveraged out with a business that I owned that was it had an extremely variable income. But again, it all comes down to the person and asking the right questions to help people come to the best conclusion for themselves. That being said, high interest rate consumer debt, it doesn't matter who you are, it's bad.
Yeah, I agree 100%.
Yeah, I think there's very few people other than the credit card companies that think that's a good idea.
Yeah, no, I'm not a fan. Now I use credit cards, but I use them when I can pay them off before the interest hits.
Yeah, we get some benefits from them, get our points,
yeah,
pay them off at the end of the month. It helps keep our credit scores high. That's all good. But paying interest on those, no.
Hey, I appreciate both of you, your perspectives with that. It's good to hear like the two different sides, right? If the debt is something you want to stay away from, and then why certain people would leverage it in certain ways, right? So I think it's good because everybody has their own journey when it comes to reaching that financial independence number, right? Everybody has their own path that they have to follow. So as long as you're making the right choices for you, what works for you, that's what matters. All right, guys, I want to transition this into something that I call the final round. It's where I'm going to ask you guys the same 4 questions that I ask everybody that comes on this show. Will give us a good idea of how you guys are when you're in a tough situation or under pressure. So if you're ready to go, we'll get this party started.
Do it.
All right, so I'll pass this off. You guys can answer in whatever order you want. Or actually, do you want to do 2 and 2 questions, or how do you want to do this? Do you guys both want to answer each question?
Yeah, that's what
we'll keep it short.
All right, I'll do it this way. So Ed, what is the biggest mistake you've ever made in your investing?
Biggest mistake I ever made in my investing, to be honest with you. Fortunately, I made it when I was young and I didn't have much money. So like I told you before, when I got into finance and investing, it was the late 90s. The tech bubble was growing. Stocks were going through the roof, .coms, et cetera. I worked construction for my father through the summers, saved all my money. That was E-Trade was new. I didn't know any financial advisors or stockbrokers or anything at the time. I went online and I bought some shares. And what did I buy? Tech stocks, of course, right? Why would I buy a mutual fund or index fund or whatever it may be? I would just buy some individual stocks and they would go through the roof. And what I learned was that if you concentrate all your money in one section in the market or in a few different companies, if one rolls a 7, essentially you lose a lot. And again, it was just with my summer money. I was still in school. I was still learning this stuff. I wasn't working in an advisory capacity or not, but I'm a very, very strong believer in Alex's as well, that you want to spread your money across the market and let the market do its thing rather than concentrate a whole lot into a few individual companies, because eventually you're going to guess wrong or get unlucky, and it can really set you back a long time.
Yeah, no, I appreciate that perspective. Okay, Alex, what about you? What's the biggest mistake you've ever made in your investing?
Mine was I'll preface it by saying this. I'm a firm believer in the capital markets for most people. I think most people could have a huge benefit investing in stocks for long periods of time and diversifying with just publicly traded investments. I did get involved with a private investment deal. It was an equipment leasing type of arrangement, and I got involved with the wrong person. It was just somebody who was not honest and was not forthright, and I'm currently owed a fair amount of money, and I'm in the process of trying to collect it, and it is a massive headache. This has been going on now for about a year, and we're at the point where we're trying to get a class action lawsuit because this guy ended up screwing over so many other people. So the takeaway for me from that was, if you are going to invest in something, no matter what it is, with whomever you are engaging in that process, make sure that you have vetted them extremely well. That was careless on my part. I had known this person for some time and never in an investment style capacity, but getting involved in that, it has been a big challenge. And so, lesson learned. If I walk away from it with nothing, I'll still be able to put food on the table and I'll have learned a lesson, but I really hope that I can recoup something from it. So know who you're getting involved with. It's important.
Yeah. 100%, 100%. Okay, next question, Alex, I'll ask you this one first. What is something that you've learned that you wish you knew when you first started?
Oh my gosh. One thing I have learned is that market declines are inevitable, and they are uncomfortable, and they are sometimes panic inducing for some people. I actually heard, when I started in this business back in the mid 2000s, I heard someone say, it's great that the Federal Reserve is so active and economy's recovering from this. And we're probably never going to have a bear market again. I can't imagine the market ever going down 20% or more without catching back up. And I remember hearing that from somebody who was older, far more experienced than I was. And I was thinking, oh yeah, that's plausible. That's great. I'm never going to have to deal with that. Yeah, obviously it's not true, because a few years later we ran smack into the worst market since 1933. But that was important, just to recognize from a young age that downturns are inevitable, volatility is inevitable, setbacks are inevitable, and to plan for them, to prepare for them, and just accept the fact that they're going to happen. I wish I had understood that back in 2004.
No, that's great. All right, Ed, what about you? What is something that you've learned that you wish you knew when you first started?
That's a great question, Mike. I think one thing would be to have trust in the financial markets, that things will work out. And I still have to remind myself about that today, because like Alex said earlier, if the markets are down and beaten up and you see your account value decline, we obviously see our revenues decline. All our clients pay us a flat percentage of assets to work with them. So our revenues decline a lot in a year like this. And most of our costs are relatively fixed. So what does that mean for profits? It means profits take a big hit. But just keeping the faith in the financial markets and being able to see and acknowledge the opportunity when things are down. Because essentially, like I said earlier, every decline in history has been a very good buying opportunity, at least the history of the US markets. And our belief is that this is something from which we'll recover. We think right now, based on what we know, that this situation is not nearly as serious as 2020 could have been. Like you said, that was a big gaping wound. And instead we have, some side effects, but a lot less bad. And certainly we're much less worse off than we were during the 2008 crisis.
Yep. 100%. Yeah, appreciate that. Okay, next question. This all kind of as you can see, they all tie into each other, right? Ed, I'll kick this back over to you again. Do you have any tips or tricks that you would recommend to someone that is just getting started out today?
Get started right away. Just you get the minimum balance you can and start to buy. And then learn how to run compound interest calculations, whether through a calculator or online, and motivate yourself. Go in and see, if I invest $100 a month into an S&P 500 fund, and you just look up the return of the S&P over the last number of decades or whatever it is, how much money will I have when I'm X years old? And that can be extremely motivating. But get started. Yeah. Take that first positive step. I'm going to research this. And no, you jump in and you do it, right? You got to get started. So many people in life are still standing at the starting line because they're investigating, or the paralysis by analysis. So this is something where pick something broad and basic to invest in and just go and do it and get started.
Yeah. Love it. Love it. Alex, over to you. Any tips or tricks that you would recommend?
Absolutely. So this may sound a little counterintuitive coming from a financial advisor, but my advice to a lot of people is don't focus only on the long term. We have to look at our immediate needs, short-term, intermediate, long-term needs. And some people get so blinded by their long-term future, they forget about the present. And you've heard the expression, don't lose sight of the forest for the trees. In this case, don't lose sight of the trees for the forest. And there's a couple different ways to interpret that. One is that don't lock yourself into a 10-year mortgage with a massive payment because you want to get it paid off sooner, when that massive payment will prohibit you from buying food. And then you're stuck because you can't. If you get a 30-year mortgage, you can always pay it down faster, but a 10-year mortgage, you can't pay it down slower. So don't focus solely on that long-term picture. The other one is more just a lifestyle thing. If everybody out there did only what was in their long-term best interests financially, nobody would have any fun. Nobody would go on vacation. Nobody would go out to dinner. Nobody would buy nice cars. Life is a very precious gift, and enjoying it, doing the things that make you happy. You just have to do them thoughtfully. If travel is important to you, which it is to me, it represents a big portion of my annual budget. I spend a lot of money on travel for my wife, my kids, and for me, because it brings me happiness. And for me, that's very important. I don't have an enormous house. Our house is perfectly fine for the four of us who live here, but that's just not a big priority. So you have to make those decisions in a thoughtful way. And remember that life is something that you get to experience on an ongoing process. And if you focus only on the long term, you're going to be miserable now. And maybe you'll be happy later on. If you spend your entire life aggressively saving and not spending any money, you could get hit by a bus the day before you retire. And then it's a life that's wasted in that respect. So find the balance. The balance in life is very important. Don't just focus on making every single best financial decision you can make. There's nothing wrong with being a little frivolous every once in a while. Again, as long as you are thoughtful about how you do it.
Yeah, do it responsibly, right? Again, you get to play this game of life once. That's it.
Yep.
So when it's done, there's no hit and restart.
Yeah.
All right. So final question, Alex, I'm going to have you kick this one off. Do you have a favorite business, investing, or real estate related book or podcast, or both? And I will preface this with besides your own, because we'll get to that.
Dang it. You took my answer, but that's okay. One of my absolute favorite books about the markets, the capital markets, is a book written by a professor at the University of Pennsylvania's Wharton School of Business. His name is Jeremy Siegel, and the book is called Stocks for the Long Run. And it is an absolutely incredible look at how the equity market in the United States has done since the mid 1800s. Now, we don't have indices that go back to the 1800s. The Dow Jones goes back to, I think, 1894, if I remember right. But this takes data back from, I think it's 1850, and just composites of companies and what their values were. And it's astonishing how the difference between the returns of equity versus fixed income versus T-bills and other types of instruments. You read this, you see these numbers, and it's just, you just gobsmacked by it. It's absolutely incredible. We've had a chance, Ed and I both have had a chance on a number of occasions to meet with Professor Siegel. He came to our office a few years ago. He does consulting for one of the fund companies that we've used in the past. And I have an autographed copy of the book, which is pretty neat. But Stocks for the Long Run, if you're ever feeling anxious about market volatility, crack that open, look at those long-term averages and say, hey, this is why we invest. So that's why I love it.
All right, awesome. And Ed, over to you.
Favorite by far, Mike, is a book written in the late 90s called The Millionaire Next Door. It was written by Tom Stanley and William Danko. And what they did was they studied people in different occupations, those that made a lot of money and didn't have a lot of money, those that weren't very showy but had a lot. And one of my favorite expressions about a lot of the neighborhoods where people have huge houses, very expensive cars, a lot of income, but very little net worth, they use the expression big hat, no cattle. And I've read that book at least 4 times. And by far, when it comes to finance and personal finance, my favorite of all.
All right, fantastic. Now, besides those, that's it for the final round. I do have one more question for you, and this is the most important question of all. For those that are listening to this interview right now, they're like, man, we really love what Alex and Ed are talking about. We want to know more about them. We understand that they wrote a book, so we want to know what's the name of this book, where can we get the book? So if you could share with us, where can people find your book? Where can people find out more information about you? Do you have a website, social media, anything like that people could follow?
Absolutely. So if you want to learn more about us as a team or as people, you can find information about us on our company website, which is birchrunfinancial.com, BIRCHRUN financial.com. Everything about the two of us, our entire team, our practice, clients we work with. There's some resources there. There's links to our podcast. And that's a great way to find us. Our book, which came out, we've actually written 2 books. Our first one came out in 2015. And then our latest one is called Mastering the Money Mind, a new way of thinking about personal finance. It is available on Amazon. You can get it in paperback or in digital versions. But if you are interested in reading Mastering the Money Mind, you are certainly welcome to go out and buy it. That will not hurt us in the slightest. We're more than happy to take a few dollars of royalties for selling the book. But if you do want a copy, reach out to us. Find us on the website, birchrunfinancial.com. Go to the Contact Us form and say, hey, I heard you guys on the podcast. I'd love a copy of your book. Here's my address. Boom, gets sent out within a couple days. We send it media mail, which is really cheap, so it'll probably take 5 to 10 days to get there. But I would much rather have that book in people's hands. And like I said, if you want to buy it, you're certainly welcome to. But I've got 800 copies of it in the storage room that we're just trying to get out there. So I invite anybody listening, if you want a free copy, come to our website, birchrunfinancial.com, go to the Contact Us page and say, hey, I want a copy of Mastering the Money Mind. We'll send it out to you.
All right, awesome. Definitely appreciate that. All right, any last words from Alex or Ed?
Yeah, the first thing that comes to mind for me, Mike, is that achieving financial freedom is not done overnight unless you win the lottery or win the genetic lottery or something of that sort. But it's very well worth it. Alex and I are very fortunate to work with a lot of people who have achieved that by doing the small things right repeatedly over the years. And we see what type of position that puts them in and what they're able to do for themselves and their families as they get older. And unfortunately, we see the other side too. People who didn't make smart choices for a long time and the regrets that they have. So stick with it, do the right things, and the result is well worth it.
And I'd like to just add one thing, is that there's not an easy way to define the right or wrong way to deal with your own personal finances. You have to find something that works for you, both financially and psychologically. Finding that balance is extremely important. If you're able to do that, just stick with it. And if you're ever in a position where you feel like you're completely lost, you're just floundering and your investments aren't doing what you want them to do, you're not saving enough, find someone like us to talk to about it. Even if it's just a quick conversation to say, hey, this is where I am right now. What should I be doing? If you give me an hour with somebody, I can get enough information to at least get them pointed in the right direction. If you're not going to work with me as a client, that's fine. I don't have to be with you every step of the way. But when you're completely lost, even just a quick conversation with someone like me or with Ed or it doesn't have to be us, any good financial advisor should be able to take you, and you imagine you're blindfolded standing in front of an open field and you're trying to figure out how to get across. In that conversation, I'll come you and point you, okay, that's probably the safest path. Now, you might bump into something on the way. You might step in a puddle, and I'm not walking beside you the entire way. If you're a client, I am, and then I can help you avoid those puddles. But talk to somebody, find out what decisions that you should make that are relatively easy, that can make a huge impact. And the longer time span you have, the easier it is to make changes long-term. And that's very important. So finding that balance in life is the most important thing of all.
I love that. I love that. All right, Alex and Ed, this was fantastic, guys. Thank you so much for taking the time to talk with me today and talk to my listeners and share your story and share what you guys do and your opinions on the stuff we talked about. It was fantastic. Really was.
Well, thank you, Mike. We've really enjoyed the conversation as well.
Yeah, this was a lot of fun. Thanks for having us on.
Yeah, absolutely. And hey, to my listeners, thank you so much for joining me and our special guests, Alex Cabot and Ed Lambert, on the Average Joe Finances podcast. Go leave us a 5-star review and tell us what you liked about today's episode with Alex and Ed. Aloha from Hawaii, and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.